Hello and welcome everyone to our session on technology innovations and data privacy implications for DFS. Hello, I'm LJ Rich, your moderator for this afternoon. Thank you so much for joining us. The Financial Inclusion Global Initiative, or FIGI, is a partnership between the World Bank Group, the Committee on Payments and Market Infrastructure of the Bank for International Settlements, and the International Telecommunication Union, the ITU, funded by the Bill and Melinda Gates Foundation to support and accelerate the implementation of country-led reform actions to meet national financial inclusion targets and ultimately the global universal financial access goal. FIGI funds national implementations in 3 countries, China, Egypt and Mexico, supports working groups to tackle 3 sets of outstanding challenges for reaching universal financial access. 1, electronic payment acceptance, 2, digital ID for financial services, and 3, security, infrastructure and trust. It also hosts the symposia. This is the 3rd and final edition of the FIGI Symposium. It provides a forum for dialogue among telecom and financial sector authorities, financial service providers, digital financial services providers, and related stakeholders to share experiences and perspectives on scaling up DFS. The session today will explore how AI and big data technologies are creating opportunities for financial inclusion while requiring readiness to address the privacy and security risks that accompany them. AI and big data are employed to reduce risk through improved customer identification and predictive analytics, resulting in lower non-performing loan rates. Our panellists will also discuss some of the additional challenges posed by AI algorithms, particularly in automated decision-making. Also, the innovative approaches implemented by providers through privacy-enhancing technologies and machine learning to address these concerns will be discussed too. Excuse me. Before our panellists, we're pleased to begin this session with our TechNote speaker, who will talk to us about the innovative application of AI in addressing the privacy issues in digital finance. Let's have the video, please, from the CEO of Signify, Jonathan Hakeem.
Thank you, first of all, for inviting me to join this group for what I hope will be a very interesting discussion. My name is Jonathan Hakeem. I'm the CEO and co-founder of Signify, which is a data analytics platform company. We specialize in creating behavioral insights, scores, fraud indicators, and so on for customers primarily in emerging markets using behavioral data, alternative behavioral data, and in particular telecom data. So I'm very pleased to be able to share with you a few thoughts today about this topic and hope that they'll contribute to the discussion that follows. So I'd like to just share my screen with you. Bear with me one moment. So anybody, I think, who's been involved in the business of big data and data analytics is familiar with this phrase, data is the new oil. I think it was originally coined by a fellow by the name of Clive Humby, who was co-founder of a consumer data analytics firm called dunnhumby back in 2006. But it was repeated and perhaps maybe given greater provenance by The Economist a few years ago when they had a cover story that talked about the world's most valuable resource being oil, being data, not oil. Well, how true is that really? Oil has a proven infrastructure for extraction, refining, sale. So once you've found oil, there's a fairly well-mapped process for turning it into money. But that's not true with raw data. It requires investment in specialized infrastructure, typically cloud-based data processing, and a team of skilled data scientists to make sense out of this data. It can't deliver value in isolation, unlike oil. It requires hypothesis testing against real world observations. So what does a good customer or a bad customer look like? How do they behave? And what attributes, what signals in the data are reliable signals of such kind of behavior? Data raises issues of privacy and security, which we'll obviously touch on a little bit more. And data needs scale, very importantly. So a very rich and interesting data set may not be particularly valuable if it doesn't have longevity over time, or it doesn't have spread across large populations in order to deliver real value. So specifically around telecom data, who has it? And obviously, most of us immediately think of mobile operators, mobile network operators. They have call data records, calls, text, data for each customer, and the attributes around each of those transactions on their network. So what time of day, where are they located, where is the counterparty that they're calling, how much data is consumed, and so on and so on. They have billing information, how much the customer's spending, how frequently, and any information about the customer's attributes when he signs on to the networks, his location, their home address, and so on. Their main advantage of this, the main advantage of this data is its scale. It covers large swathes of the population. There may be typically 3 or 4 mobile operators, sometimes less in the country. In between them, they have coverage of the whole population. Challenges, however, strict regulation really steeped in the telecom operator as a service provider, as a utility, which needs to protect its customers and their information. A lack of infrastructure, and that's particularly true in poorer countries where the ubiquitous cloud-based services which we're accustomed to today, Amazon, Google, and so on, are either small or in some cases not even present at all. And thirdly, the data that mobile operators are collecting is changing. There's a rapid decline in voice calling as data-only networks take over. And those data-only networks are less rich in terms of the attributes that they capture for the individual customer. So today, the primary use that the mobile network operators make of their data is for internal marketing, for improving the customer lifetime value, for cross-selling them new products, for acquiring customers from their competitors. The second owners, the second aggregators of telecom data are OTP providers, over-the-top providers. The big ones, social media companies, WhatsApp, Facebook, Amazon, Google. They gather data from their mobile apps with the opt-in permission from the customer. And because of that, they have great flexibility in what they can use this data for. There are some challenges that they face, in particular the growing privacy restrictions, which are being adopted, or which are being implemented by the operating system, the developers, by the owners of the 2 main operating systems, Apple and Google. But the primary use case for this kind of data is digital advertising, which is an enormous and highly profitable business. When we look specifically at telecom data in DFS, we can see that with few exceptions, mobile operators have failed to develop any scalable financial service products. Why is that? I think 3 or 4 reasons which we can pick on. Lack of investment in the appropriate data infrastructure, data privacy restrictions, which we talked about before, that prevent sharing or aggregating raw customer information, difficulty developing commercial partnerships with balance sheet providers, that kind of commercial discussions over who owns the customer, whose customer is it, how much revenue is being shared between the two. It's a non-core business for mobile operators that has limited impact on customer ARPU. And increasingly for the consumers of this data, there's increased availability of other non-traditional data sources, particularly social media, that compete with telco data. So consequently, digital lenders today, the new wave of digital lenders, whether they be lending apps, marketplaces, and so on, they typically rely on app-based and other types of data. So I've just listed a few here: Tala in Africa, Neon in Brazil, Julo in Indonesia, and so on and so forth. Maybe a couple of words about an interesting case study that we've been involved in Brazil, which is, I think, exception to what I've just talked about. We have developed a partnership with the 4 main mobile operators and one of the major credit bureaus in the country to create mobile-based scores for fraud and risk, which are particularly valuable for the 40% or so of the country's population that is underbanked or unbanked today. So how does this work? First of all, it's a collaborative model. We have all 4 mobile operators on the platform. And the reason that this dramatically increases the value to everybody is a kind of networks effect business where coverage makes the data much more valuable to the consumers. So if a bank understands that it's highly likely to find data for a customer or prospective customer in this database, it makes it a much more valuable data source. The participation of the credit bureau is important, not just for the data security that it offers, hosting the data, but because it also offers low-cost distribution to the major consumers of these kind of products: banks, insurance companies, retailers. Think about building a specialized distribution channel for alternative scoring products. It's very expensive. So this is a key ingredient in the commercial makeup of this product. Thirdly, the data privacy rules in Brazil, LGPD, for those of you who are familiar with this, for those of you who are not familiar with this, the rules are very similar to GDPR regulation in Europe. But interestingly, they permit the use of customer data for 2 cases, fraud and credit, without the specific opt-in of the customers. So this creates a space for using data on big scale without a customer opt-in. Fourth is that this is an inquiry-only model. What do I mean by that? It means that data that is collected on customers resides with its owners, with the telecom operators. And what we are doing is using software, a kind of layer of software above that, to query those databases and get answers from them, yes or no. So for example, I want to know, does this cell phone number match this customer's national identity number? Yes or no. I can query those databases, yes or no. I'm not disclosing any fresh information that the consumer of this score doesn't already have. He already knows, he already has a score, he already has a phone number for the customer, he already has a claimed customer ID. Do they match? So this is a way of extracting sensitive raw data from its source, but still creating value out of it. And the first product that is already launched and in the market is what we call a localization score. It validates the home address or the work address of a particular customer using his geolocation pattern as a mobile phone user. And this is used for validating, for onboarding process, especially with digital services, e-commerce, online financial products, and so on. So a few thoughts here about how could telecom data be monetized more effectively. Well, I think clear data privacy and usage rules, and these should apply not just to the mobile operators themselves, but across app providers who are in this same universe. Align permitted data usage with public policy or financial inclusion objectives. So just in the way that countries are starting to, regulators are starting to make data available, open banking data available in order to stimulate competition within the banking system. There are certain use cases for which customer data can be permitted, as we've seen in Brazil, to help financial inclusion. And maybe if there are no credit bureaus, or maybe if there are no, maybe there could be even publicly owned data collaboratives which can securely host this data rather than necessarily relying on credit bureaus, which can then be accessible by financial institutions for purposes of financial inclusion, promoting financial inclusion. Those are some thoughts about where we are today. I hope it's useful and look forward to participating in the discussion.
Thank you very much to Jonathan Hakeem from Signify, who'll be joining us later on in the panel. Some interesting points raised. And before we do open the panel, we're going to start with some introductory remarks from each person. It's a nice way for everyone to say a few words before we get into the discussion. So let's begin, please, by welcoming Rory McMillan.
Thanks, LJ. Can you hear me okay?
I can hear you very well.
Great, excellent. So, in the 18th century, a local shop owner might know the lender or might get a local business to vouch for his or her creditworthiness. But then the 19th century brought in a lot of industrialization, migration to cities, and the whole change of distance, depersonalization really stretched social trust among people. So credit information had previously been informal, ad hoc, anecdotal. This didn't work so well anymore. And so lenders began hiring spies to go and look at their potential borrowers and figure out what they could about. In 1830, a fellow called Lewis Tappan and his brother opened an organization called the Mercantile Agency, and they began collecting and systematically organizing detailed information about business owners across the US. They produced ledgers, identities, assets, local reputations of business people, and they abstracted that data, gave it numbers, and sold subscriptions in a centralized reporting service. So thus was born the notion of the credit agency. They defended this against criticism, saying it was not a, quote, system of espionage, but the same as merchants usually employ, only on an extended plan to ascertain whether people applying for credit are worthy of the same and to what extent. This was the big data of their era. So we know information about a consumer is really fundamental, right, to financial services. It's key to the identity, so you have confidence that the person you're sending money to is the person you want to send it to, or you know enough about them that you're prepared to take a risk on them, or how much risk you want to take, that they're inclined to repay you or will be capable of repaying your loan. We know now that AI is being used to verify identity, to assess, to score people's capability and inclination to be good customers using a range of social behavior, social relationships, effectively gossip in a lot of cases on social media. So as the CEO of Zest Finance, which uses a Chinese search engine Baidu to gather people's social history, location data, he said famously, all data today is credit data. So we've gone far beyond this world now of official data from the credit agencies. We're living in this period of alternative data, where not only do big data and AI require huge volumes of data, we're told that the accuracy of the results, the functioning of the system itself, depends on those huge volumes, those unlimited, effectively, volumes of data. So we've been living in recent years through a period a bit like a move to the Wild West, where vast unexplored territory and natural resources of data are there for the taking, just depending on who got there first. And we've seen large tech companies really making it there first, and then who can defend it best. The gold rush then is followed by the intermediaries in our world, the data brokers, who are now able to sell the nuggets of gold, the data lists with attributes about each of us, our behaviors, our preferences on the secondary market. This is then valuable, used for digital financial services. We're seeing, in reaction to all of this, something of a techlash. We're seeing that in the attitudes of consumers, and we're seeing it in the adoption of privacy norms, increasingly in laws, regulations. So this is driving technical innovation to meet this demand for better privacy. We are seeing efforts to mitigate the risk to privacy, including in the way that machine learning models are trained and models are used in AI. So just for example, we have remote execution, a technology which allows you to run the computations on data, where the data is on devices, on servers, which you don't have access to. So instead of moving the data set all from the devices onto a centralized database, you're able to apply the model on the device where the data is, which might even be a smartphone. And then aggregate the federated learning, federated from different locations, different devices, to gather the training model you need for applying your decisions. Or we're seeing techniques like secure multi-party computation, SMPC, where a model may have multiple owners with multi-party computation, breaking up some of the numbers with each party that holds some of the numbers not knowing the whole picture, and thereby preventing anyone being able to assemble the data with the privacy, which would violate the person's privacy. We're seeing differential privacy used increasingly, which introduces noise into the data to the extent maximally possible without actually reducing the robustness of the analysis. I think we'll hear more from Andrew later on about these and homomorphic encryption and other technologies. We looked at some of them in the study that this work stream, the cybersecurity and trust work stream, carried out early on in the FIGI, where we looked at AI systems, privacy, security, risk of bias, problems of accuracy. I think what's becoming evident now is we can no longer look at privacy in terms of a zero-sum game, a sort of trade-off between allowing the data to flow in order to make services available and protecting privacy on the other. This is more about how data is shared. So Jonathan's description of their work in Brazil is a great example there. And I think Nayaran, later on this panel, will also share examples from India, where the raw data about the consumer stays with the source. It's not gathered into one centralized aggregated place where it's transferred around and made insecure. There, the telecom operators and credit reference bureaus, they don't transfer it to anyone. The models can interrogate it, generate the insights that they need, but without gathering the whole lot of data and exposing the population to the privacy and data security risks that would entail. This depends on various things. First, it's easier when you're dealing with 3 or 4 mobile operators. They're large, they have licenses which you can take away, they have similar types of data, whether it's phone usage, top-ups of their accounts, payment of phone bills, regular locations people visit. It's easier perhaps to bring all of this together, but I think what this shows us is it's pointing us in healthy direction in which data is made available, just in a way that's more limited to what's necessary for the purpose. The second thing, and maybe I'll close here and say a bit more about this later if there's time, is I think there's an opportunity to standardize more of this for the common good. We looked at this in another paper we did in this work stream, this cybersecurity and trust work stream, looking at the use of telecom data for digital financial services. Paradoxically, it may be easier to protect data and privacy, limiting what's made available where the data is affirmatively organized to make it available, just in a careful manner, using perhaps agreed standards. So the solution is not to close off access to all the data in a radical way. It's rather to allow the access, just organizing better how it's done. And so those are a couple of thoughts, partly in reaction to Jonathan's very, very helpful input. And with that, LG, I'll hand back to you and look forward to the discussion as we go on. Thanks.
Thank you very much, Rory. A roaring start, in fact, to our panel. And now it's time to welcome Andrew.
Thanks, LJ. And thank you, Rory and Jonathan. I'm going to pick up on some great themes that you guys highlighted. So we are in a world where data is ever expanding, and we are in a place where we can use it for the greater good of the individuals and get them included into financial systems. And one of the areas Jonathan touched on, and I think Rory touched on a little bit, was what we would otherwise call open banking. That banks and financial institutions in many countries are being regulatory encouraged, or and sometimes forced to, make available a consumer or an individual's data in order to make it usable for secondary purposes, such as personal finance management, loyalty programs, and such. But one of the really useful and high value uses of it is to get the person included in the financial system. That if I have a debit account, I now have the ability to make that debit account data, or some people would think of it as a checking account, that debit account data available for use for credit. And this is a new kind of data that typically has not been reported to the credit bureaus that Rory has referenced, because credit bureaus look at credit. They really haven't looked at cash flows per se for individuals. Sometimes that's happened in a commercial context, but much less so for individuals. So we're now approaching this brave new world of new data assets being made available to enable and empower the individual, to get the individual included in a financial system. And so I think we're in a great turning point for the availability and usability of data. And honestly, this isn't going to be just about financial data. We've started with financial data, but in many markets, like in Australia with the consumer data right, there's a much broader view of what the data that should be available to the individual, and therefore for secondary purposes, such as trying to get credit, what data should be available. And so, for example, in the UK, they're moving from open data to open finance. I think Europe is moving the same way. Australia is there. And then in the US, our unregulated market, as long as the data is available, somebody will figure out a way to get access to it. And one of the places where they're actually making it available in a little more regimented fashion is Brazil, which is one of the examples Jonathan mentioned, which is through the open banking scheme, they're actually making credit granting and credit decision something that now has to be available via APIs. And that means it's real-time decisioning based upon real-time data. So this is all great, right? And it's all privacy friendly in the sense that this is all consumer permissioned or individually permissioned. In order for somebody to use my data, I have to basically authenticate myself to my bank account, and I have to grant the access. And so here I, the consumer, am well aware of it's going on, as opposed to some of the other examples of where data is used and individual data is used. And I, the individual, have control over that data. I can say, stop sharing the data, destroy the data. There are a lot of rights being granted to the individual in this context, which again is great. The thing, though, that I think we all have to be very mindful of, this is new data that hasn't been available for this purpose before. So for, as Rory was mentioning, we have existing credit bureaus in many markets, but those credit bureaus haven't had this data. And that's why we are, the nickname for this kind of data is called alternative data, because it's not the standard data that we've used before. And now that we have this alternative data, I think we all have to be very mindful of how it is used and how we could actually potentially harm individuals or potentially discriminate against individuals from data assets we're not used to using for these particular purposes, that we're not used to checking the veracity of, that we're not used to checking the quality of. And so now I think as responsible data users in the space, we all have to now start thinking about those issues and thinking about how are we ensuring we're not introducing new bias? How are we sure we're not introducing fake data? And some easy examples to consider is if I share my apartment with somebody, maybe some months that person's paying the rent, maybe some months I'm paying the rent. And yet, if you look for a rental stream as one of the pieces for a credit decision, well, it looks like I'm inconsistent. but maybe I'm not really inconsistent because I'm sharing the rent with a roommate. And so those are just simple kinds of things that we're going to have to look at as we're looking at these new data sources. And so it's a complicated new world. The other thing that we're going to have to consider is, are spending patterns different by racial category, by ethnic category, by gender? We don't know yet, right? I think this is a brave new world that we need to investigate, and therefore we need to implement controls. And so in the credit industry, there has been a practice and standards for the kinds of controls that you can implement relative to monitoring for bias, looking for bias. Those kinds of controls will now need to be introduced into this new world order of the additional data and all the new technologies that Rory was referencing. So as we move to AI, those same kind of controls that we had for monitoring for bias, of looking for bias, monitoring your models, looking for disparate impacts, all those great controls, we now need to figure out how we're going to do them in AI. I won't say it's easy. I think this is going to be a journey for us. It could be a little bit of a black box, but I think it's a challenge we're all up to. And I think it's a challenge that all of us should be thinking about and moving forward on to enable people and get people included in the financial system. And so with that, LJ, I will hand it back off.
Thank you very much, Andrew. And audience, you are more than welcome to put your questions to our panel. Please place them in the Q&A, not the chat, because they tend to get lost in the chat. And also that means that some of our panelists with fast fingers may even be able to answer your question before we even get to it live. Thanks, Andrew. It's now time for Margaret, who's next, and she's ready already as well. Thank you very much.
Thank you, LJ. It's a pleasure to be part of this distinguished panel and on such an important topic. I find sometimes when talking about financial issues around financial capability, financial consumer protection types of issues, it's often helpful to make a comparison to something that I think is similar, which is one's health. If one imagines that by using your computer, you could detect that you had, let's say, some kind of, because you're using the camera on the computer, some kind of illness in your eyes, and that could enable you to get care more proactively, maybe helping to save your vision. I think a lot of us would think that's a great use of the computer. It's going to be able to help me. That's kind of an unambiguous positive impact. But if you link that then to a decision maybe about health insurance, and that the fact that maybe the computer is able to, or the data collected through your device is able to say you may be at higher risk for some types of illness because of that, it gets more murky. And I think this is where I wanted to talk about the role of consent. If somebody consented to being able to get information about their health that might have been able to be detected through the use of their device, they may feel positively about that. But if you told them that same data may also be shared and taken into account in financial transactions where it may have a detrimental or a higher cost impact on them, then they may not be so willing. And I think this is kind of at the core of how do we make sure that as people willing, whether not knowing about it or not knowing about it, all of these data are being collected, and we're going to talk about consent. It's what I want to focus my remarks on, that it really ends up helping people. If this huge new data world ends up being, positive for people, there's going to be participation, and people will be voluntarily participating. If they feel like there's a lack of control and a lot of detrimental impacts, that's where we're going to have more issues and more controls around innovation. And really what we're trying to see is how can we make sure that innovation continues, competition is strengthened, because in a lot of markets there isn't adequate competition and innovation, and yet at the same time we have the protection for people. So I'm going to provide some remarks linked to a paper that's forthcoming from us on consent as part of open banking. And I think something that's very interesting about this topic, I'm an economist, not a lawyer, is that the PSD2, and I'm going to look at initially kind of at some of the issues from PSD2 and the GDPR, which are really serving as the anchors globally for a lot of the regulation on this. PSD2 comes from competition law, business law, whereas the data protection regime is from human rights law. And I think this also creates kind of a tension about how to reconcile these two different but very much related issues when we're talking about something like open banking. And a consent is really often the bridge between the two, giving the consumer more control over how their data is used. And I want to just clarify, because I think it's not always maybe fully appreciated. What does consent mean? I think a lot of us know, ticking the box seems to be not at all adequate. And I think that there are a lot of issues with consent. But the consent as seen in terms of this topic through the GDPR and the subsequent guidance provided by, for example, the European Data Protection Board, goes into some more detail that I think it's useful to think about here. One is the consent is to be freely given. And what that means is that if you are signing up to share data in order to, for example, receive a decision on a credit product, at the time that your data is collected for that purpose, you shouldn't also be asked to provide information which could be used to make decisions on employment or used in the future, maybe for insurance products. The freely given is linked to kind of the scope in terms of that it shouldn't go beyond the objectives of the specific contract into which you're entering, or the use case that you are providing consent for. So it's understood that in order to complete a contract, you need to share certain data. There shouldn't be expectations that even more data has to be shared for other potential purposes when you're entering into that contract. That would mean that beyond the data for the contract, you're being compelled to give even more access to your information. So that's the idea around freely given consent. Specific also has to do with this specific nature of why you are providing consent. So overly broad statements that you are providing data in order to support a business relationship with a data processor would be far too broad. So it needs to have clarity and some narrowing of purpose as to why the data is being collected. It also needs to be informed. And I think this is one of the really big challenges. It needs to be available in clear language, and it's something that people would understand. One of our colleagues who's worked for years on issues around data protection and privacy, David Medine, who was previously with CGAP and is now working also with the Center for Global Development, has mentioned that research suggests that if we really looked at all of the privacy provisions that come to us through our use of websites, et cetera, it would be 76 days that it would take us every year to look at those fully. And obviously, probably you'd need to have a legal degree to understand much of it. So, informed consent is important. In its current structure, it's clearly really unattainable for essentially everyone. And then the final is it needs to be unambiguous. And what does unambiguous mean? It means that there can't just be assumptions. For example, you scroll to the end of the information, and that means that you must have read what was there. Or there's a pre-ticked box and you didn't take the check off, so that means that you are in agreement. Unambiguous means that it needs to be separate from just accepting the contract. In some cases, that means through, for example, a two-tier authentication process. But there are different ways that you can do that. Having a completely separate page, separate from contract terms about agreement to participate in the consent for the data protection. Other aspects include the ability to withdraw consent. That doesn't mean that you would withdraw from in a way that would create problems for the transactions that you had consented to entering into, but that there is a way to withdraw, that it's time bound so that it's not infinite in terms of the use of the data for the particular purpose to which you are consenting, and that there's a way to lodge a complaint or a concern if you have one in terms of the data decisions. So just real quickly, how, consent. So consent is certainly something that provides protection to the consumer, but it also has its limitations, as we've discussed. A couple of other suggested approaches to complement, I think not to replace, but to complement and strengthen consent and the role that the protections provided to consumers. One is fiduciary expectations. I think of this a bit like the doctor's oath of doing no harm. It's an assumption that would be illegal that the customer's best interests need to be put forth first. India has a new data protection law where they talk about that the expectation would be fair and reasonable behavior by the data processors, ensuring the privacy of the individual. And you would only use data for purposes that the individual would reasonably expect based on the purpose, context, and circumstances in which the data were collected. Another related concept is legitimate purpose. And I think this was mentioned previously by Rory around Brazil, that the data can be used for credit offers because that is a legitimate purpose. That's something that is expected to benefit others, benefit the data subject. So these should be compatible, consistent, beneficial purposes for using the data. In instances where you can robustly de-identify or anonymize the data, you could also use the data for innovation. So it's a way to balance, again, data subject privacy with opportunities for innovation. A final new approach, which has not been at all fully implemented, is dashboards. And the idea here is, as more and more data are available on individuals, that there would be kind of a common landing space or common, app, website, et cetera, where an individual could really see what are the data agreements that they have made, how is their data being used, and thinking of the Fair Credit Reporting Act. Has been alluded to a bit, and other similar legislation. One of the very powerful aspects of that was to allow consumers to see who had pulled their credit report. When you see your credit report, you see how your data has been used recently. And you can see if there are anomalies that you would identify that maybe the system itself wouldn't even be able to identify in terms of fraud or misuse of one's data. Australia is, I think, one of the leading countries in trying to implement this dashboard approach. Just one or two final comments. Bias has been mentioned. I think that this is incredibly important because we all know that systems are only as smart as how they were built, and I think there's for me a significant concern that there isn't enough gender diversity or diversity of people coming from different backgrounds. By a lot of different kind of metrics, and there really needs to be a lot of thought going into not just protections, but getting more representation at all levels in the technology aspect, but also in decision-making and senior management roles, so that people can identify these issues and make sure that there's more proactive addressing of these types of maybe biases that are being put in, and those being able to be detected and addressed and before they create harm. So with that, I'll stop, but I look forward to the discussion later. Thank you.
Thank you very much, Margaret. And a brief nod to how we all need to have clean, decent data sets. Yes, we completely agree. And it's now time for Alex. Thank you.
Thanks so much, LJ. And I think have a couple of slides here, but just wanted to say thank you to ITU for such a great symposium, and it's a pleasure to be here with all of you. Just very briefly, next slide, on the Center for Financial Inclusion. We're a think tank housed at Axion International, which is a nonprofit that's focused on financial inclusion through investment, technical assistance, and research. And CFI is about 13 years old, and we've worked on research and advocacy in most recently 4 big thematic areas: consumer protection, responsible data practices, climate change and resilience, and gender and financial inclusion. And really the common thread through all of that is a focus on the consumers and how to best protect and advance their well-being as inclusive finance changes. Next slide. So we've been thinking a lot with these thematic focuses. We've been thinking a lot about how the plumes of data fumes are transforming inclusive finance for consumers. And as all of the panelists have said, whether it's mobile network operators or OTP providers, as Jonathan mentioned, the democratization of mobile phones and advance in analytics and data infrastructure have created huge plumes of data that are being leveraged by all sorts of different stakeholders, whether it's providers in new product offerings or regulators for innovative supervisory methods to look for fraud, to advance financial inclusion. And that, of course, has been even further accelerated through COVID and a push by many stakeholders to increase the pace of digitization. Next slide. So with all of that, we've been thinking, I think, picking up on, or maybe diving a bit deeper into some of what the other speakers have talked about, is just this idea of digital data trails and how they've exploded, but also how they tell stories about individuals and how reflective those stories are of individuals' economic potential and what they might actually leave out and why. And so what we mean by this is that data trails are reflections of individual behavior, but also digital capability, social norms, other contextual dynamics, which might not have the actual full story of someone's economic potential. And since digital finance, and we've largely focused on credit models in our research and thinking, they leverage so many phone-specific variables. The interaction between these data trails and marginalized, underrepresented groups is not very well understood. I think that dynamic can be most easily articulated through a gender lens due to some existing empirical evidence. We know that women are 8% less likely than men to own phones and 20% less likely to use mobile internet. And even when they do use their phones, we know through research that their behavior is mediated through social norms, whether it's the reality that women are subject to more digital harassment or social stigmas around phone usage. All of that helps determine their data trails and also how those data trails are gobbled up by algorithms that determine creditworthiness or other economic opportunities. And I think because of existing evidence, you can articulate that for a gender, but it absolutely must be explored for other marginalized groups. And a lot of that is very market and country specific. And so in a recent paper we wrote, we explore this dynamic of some of the stories that data-driven algorithms can tell about who is creditworthy in emerging markets, what the risks those narratives and stories might have in terms of who's left out or excluded or whom those are biased against, and what it all might mean for financial inclusion. An anecdote that really stuck with us as we were doing this came from the commercial healthcare industry in the US, where there was research that showed an algorithm that had been used to predict the needs for individuals who might require high-risk care management. That algorithm recommended that white patients receive more comprehensive care than equally sick Black patients. And that algorithm relied on past healthcare expenditures to predict what care a patient would need. But in America, we know that African Americans have had to deal with decades of institutional or cultural barriers in their access to healthcare, which resulted in lower past expenditures. And so really the story that this algorithm was telling in predicting the healthcare needs was not the patient's actual medical need, but rather the history of disparate access to healthcare between white and Black America. Next slide, please. So in this, in our recent work, we started to expand or think about how to apply this, this dynamic to the inclusive finance space. And I think Andrew mentioned earlier kind of the behavior of two roommates that might lead to confusion about someone's financial behavior by a lender. And so we sort of did something similar to that in the paper, where we tried to lay out the differences between what a data trail might say about you to a provider, but what the real story might be, focusing on those that are most likely at the data margins. So for instance, your relatively small number of monthly mobile money transactions show a low level of business activity, and you're a poor risk for an MSME loan. But in reality, the majority of your transactions are conducted in cash offline. The third one down is you have infrequent mobile money receipts on your SMS log on your phone and insufficient evidence of cash flows. But in reality, you share your phone with a multi-generational household, and you need to frequently delete old SMS messages because your phone storage is limited. So these were some of the issues, next slide, please, that we explored, and I think in our recent paper, and I think we've all said why delving into examining data trails, the inputs to these systems and the systems themselves are so important in inclusive finance. And that's not to say that algorithms and these products don't have the potential to overcome some of the big financial inclusion challenges that we've faced, including the biases that come from face-to-face interactions when it comes to offering financial services. And there's research to back it up. But the scale of these deployments, the pace of change, the explosion of data trails really merits a closer examination and research. Next slide. And so this paper that we put out recently was to ground some of these universal issues around algorithms, bias, and inclusion or exclusion in the field of financial inclusion, and to get a bit of the lay of the land in terms of how different stakeholders are thinking about this through interviewing fintechs, consumer advocacy organizations, regulators, to understand the levels of awareness and what tools for accountability actually existed, whether that came from the industry or regulators. And we used a framework of input codes and context for the purposes of breaking down the product development, algorithm development cycle, and for the purposes of identifying spots where exclusion or bias might creep in, but also where tools for accountability might also be applied. And input refers to the signals, the training data that being used that we've talked a lot about thus far. The code is pretty self-explanatory. And the context is also how the algorithm operates within an organization in terms of the staff, the culture, the processes that surround the creation. And of course, all of these are intertwined in reality, but we just found it a helpful tool. And I think, as all of the other panelists have alluded, we are our landscaping found that we are very much at early days in this work. There's a lot of research and evidence needed to advance and feel like we can find best practices. I'd say there's certainly a lot of awareness among fintechs and providers that we interviewed around the importance of this issue, but they are often not necessarily incentivized to focus on this, with focus from investors to keep customer acquisition costs down. And so there's a lot of work to do. Look forward to discussing some of those findings, but also some additional areas for work in discussion. So with that, I'll turn it back to you.
Thanks very much, Alex. And yes, it really does feel like we're right at the beginning of some gigantic changes. And it's events like this where, audience, you get the opportunity to interact with people and maybe change the future. Okay, thanks very much, Alex. It's time for our final panelist before we open up to everybody else. And that is Narayan. Hello there.
Hi, LJ. How are you doing?
I'm good, thank you. How are you?
Doing very well. Thank you so much. And good evening, everyone. And thanks for putting up a great show. It's a pleasure to be here. So great. My colleagues, Rory, Andrew, Margaret, have all spoken about a lot of things regarding telecom data, about underwriting, about credit, financial inclusion. In India, we've experimented one more dimension of using telecom data. So typically, I've tried to put everything in one slide. So on the left-hand side, you will see the traditional telecom data attributes which are there. So you've got the business users, you've got his SMS history, you've got the call logs, you've got CRM data, you've got device and app and browsing history. The reason I'm saying this is because India is a very uniquely positioned in the world when it comes to financial inclusion. Currently, as I speak, roughly about 400 to 450 million Indians are yet to be banked. They are unbanked. And about 700 to 750 are yet to be inducted in the formal financial ecosystem. So what does that mean? So we're looking at 50% of the population which is not yet into the formal credit system, right? And about 20% which is yet to get access to a bank account. So you're going behind the 50% which is banked but yet does not have access to financial products. Most telcos and bureaus, what they have done is, basis the various data, they've formed their algorithm using big data and machine learning, right? So on the supply side, you've made your inventory, you've tied up with telcos, you've done the scoring, right? And because of 4G penetration in our country, a lot of Indians are mobile first internet. So they did not have access to desktop, they did not have access to broadband. So mobile was their first interface with the internet. And because 4G phones are really rock bottom priced in India, so you get a decent, sizable 4 GB RAM, 4G phone for about $100. So that's a decent price. And that has moved a lot of people from 2G to 4G directly. So on the supply side, without compromising on any PII data, the telecom operators with analytics company have worked out various logics. So typically, broadly, the two use cases that was being explored was underwriting. So it was a means of an alternate credit score. You had location-based services to track his location and then augment your alternate credit score. And you had KYC validation. And last, which was experimented but not yet progressed, which is attributes for loyalty. So basis your transaction on your mobile phones, what is that can be upsold or cross-sold to you for loyalty purposes. So the blue mark is where it's a highest consumption, and the white circle is it's experimented but not with much success. The second use case is mobile wallets. What happened is telcos realized that they can propel financial inclusion. So let me form a mobile wallet of my own. So while Africa is a very unique market where M-Pesa, which is the Vodafone mobile wallet, has worked great, India is differently poised. You have a sizable bank population, but not formal credit system. So mobile wallets were opened by practically all telcos as a means for an alternate bank account. So the 20-25% of individuals that I was referring to who are not banked, so for them to open a bank account, what are the challenges the telcos faced for the mobile wallets? There was a limitation of merchants. What do I mean by that? So you've opened your mobile wallet, you've opened a semi-bank account, but you need merchants, you need alliances who will accept your mobile wallet as a legit instrument, right? So it talks about penetration of mobile wallets. So that had gone into a bit rough waters. There were regulation limits so that it's not abused on a SIM card. The limitations were that you cannot have transactions worth more than $100, $150. That doesn't mean there are a lot of people with more than $100, $150, but it called for strict regulations that if you're transacting, you need proper KYC, you need proper documents, it has to go a lot of verification, which added up a lot of cost for mobile wallets. Last was no interoperability, means I change from operator A to operator B, but my money is in the payment bank of operator A. I cannot bring it to operator B. So I needed a bank account where I could transfer it and then bring it back. So these use cases were trying to get some success. What did we do at vServe? We did something different. We went a step ahead of this. We tied up with telecom operators. So in India, we've got 3 telecom operators. 2 are working with us. So on the left-hand side that you see, we get access to all their records without any compromise on PII data. There is absolutely no compromise. We get access to that data. We've formed models. We've churned various segments out of it. And we use it for a different use case, which is on the demand side, which is consumers, a simple human being or a simple layman who's using a telecom SIM card for the last 1 to 2 years or 5 years is not aware that he can walk up and take it to use his SIM card for various services, right? He's not aware that I can walk up and take my SIM card to maybe a lender, maybe an NBFC, or even a fintech, and get access to financial products. So there's a big journey on the awareness part. So what did we do? We created profiles based on various risk scores. We mapped relevant products based on the cohort that we formed, and we started targeting them on digital platforms. So for Facebook, India is the second largest market for Facebook penetration, right? So we target users digitally. To give you a live example, based on the segment, because SMS on your mobile phone, I have your IP, I know your data, I know the SMS that you're transacting. So I know what's your merchant, from whom are you getting? Are you getting it from a bank? Are you getting it from a credit card company? Are you getting it from insurance? Whether you're two-wheeler, four-wheeler, whether you're transacting on any particular app. So there are various segments that we form. And then we go to brands and say that, hey, you want to increase your financial product penetration? I can give you better and relevant audiences that you may want to target too. So to give you a live example, we are working with 2 insurance companies. So from the telco database, we've picked up segments who are doing reasonably well on their payment history, so just the ARPU, but they do not have any insurance or any credit card transaction at all on their SIM card. So we picked up those folks based on the location and other basic criteria. We located them on Facebook, showed them like a sponsored ad because the insurance company paid for that profile, right? And they saw that, yes, in this whole pandemic, it's better that they take out an insurance and it's customized for their needs. All they had to do on Facebook is click on, buy now. They get diverted to the landing page of the insurance company. We worked out a process called digital onboarding, where complete 100% onboarding, that once you're transferred to the insurance website, you enter your basic details, your basic KYC details, and you complete your application. And within 30 minutes, the insurance company calls you that we've got your details, you've got a pre-approved offer, just pay this amount, or if you cannot pay it, somebody will come to your doorstep to collect it, and then the policy will be given to you within 1 week. Now, we used telco data, we used algorithm, and we propelled financial inclusion by doing lead generation. And by lead generation, I mean going to the last mile, the actual consumers. So we bridged the CMO world and the CRO world together using the solution, right? How did it work for the insurance company? They had about a 22% increase in their sales on the digital platform compared to their regular digital activities that they were doing. So using their regular processes, they've got a 22% increase in sales with a 9% reduction in cost of acquisition. So what happens is there are more insurance policies that are given out at a lesser cost of acquisition, which works for the benefit of the insurance companies. And the consumer gets a pre-approved offer. So he is not even aware that his telco data was analyzed. There was some algorithm working which said that, okay, the next best product this gentleman should get is insurance product. He was targeted with an insurance product on digital platforms and he opted for it. To give you another example, to propel financial inclusion, as a replica or rather to surrogate the limitations of mobile wallets, there's a concept called buy now, pay later. I've just used the abbreviation on my slide. It's called BNPL, buy now, pay later. It's a $100 billion opportunity in India. What it means that you can not, instead of opting for a financial product, you can opt for this product where you buy, you pay later. After a week or 10 days, you can pay it in cash or some other medium, right? So this is the use case that I wanted to share with you all, that this is how we have propelled financial inclusion in the country. We are working with the top 3 banks of the country, top 4 insurance companies, and in the process of working with few credit card companies as well, including buy now, pay later. So that's the use case that I wanted to share with all of you guys. Thank you so much for your time and really appreciate the session.
Thank you very much, Narayan. And it's at this point I'm going to ask the rest of the panelists, please, can you turn on your cameras and microphones and stop doing whatever else you're doing on the computer at the same time. I can see brilliantly some of you are answering questions from our audience as well, which I really like. And as we go through today's panel, some of you who know my moderating from previous panels will know I'm really happy for you to intervene or compliment or comment on the reply of fellow panelists. And there's also an opportunity for audience. you can ask questions as well. We're so grateful for you to put them in the Q&A tab so they don't get lost in the chat, and it just means that the questions remain viable for us to answer. So let's start with a question to you, Andrew. What are risk-based approaches to the application of privacy-enhancing technologies?
Sure, LJ, I'll kick it off. So the privacy-enhancing technologies are technologies that we use, as the name says, to enhance privacy. They're not always necessarily 100% sufficient, but they are tools to mitigate privacy risks. And so we've tried to think of them in different buckets. I know Rory mentioned a couple, and so I think it'd probably just be useful to even walk through how we think of them just from a technology perspective. The tool that many of us have been using over the years is simple anonymization or obfuscation, which is that you remove the direct identifiers from the data sets. And so if I have a name, just replace the name with the universal identifier in the data set. The concerns in doing that, however, is that the data is pretty reversible. So if you have another data asset that has any overlapping data, you can marry it back up and get back to Andrew's name pretty quickly. However, it's pretty useful in just protecting data from leakage internally to ensure that you're using data appropriately and engaging in data minimization behind your own firewalls. You then also have what we would call data destructive techniques in that, where you just totally remove Andrew's name and address, and you might have information just that there are 500 of these kinds of cell phones for Verizon, right? And therefore you go through data destructive means to anonymize the data, but that tends to destroy a lot of the value in the data, and so it's not necessarily the most favorable thing. The next grouping of tools that we look at are synthetic data. And I think synthetic data, there are a lot of synthetic data generators out there. I think the nice thing about synthetic data is, as the name implies, it's synthetic. It's not real. It's not the person's name. It's not the personal data. You make it all up. And since it's all made up, great. It may not be personal data. The problem is because it's all made up, somebody doesn't know the veracity of it. It's hard to challenge the veracity of it, to check the statistical quality of it. So I think there's a lot of questions from the data scientist community as to whether it's good enough. I would say this is an evolving space. The quality of synthetic data is ever increasing. However, the use cases are demanding ever better data. So as we move from simple linear regression to AI, the demands on the data get more. And so therefore, I think there's a lot of questions there, but I think no matter what, it's a great starting point to look at, because it's fake data, right? You create your own fake data set. The next piece is homomorphic encryption. And everybody, I think, is used to encryption as a security tool, that you encrypt the data and you can't reverse it back out with an encryption key. The nice thing about homomorphic encryption is that you can actually do math on it. So if I encrypt A and B, two values, I can add A and B. And then when I back it out, I get the summation of A and B without knowing what A and B individually were. And so it's a great way to get to data analytics without having to expose the underlying data, which I think is where Rory was going about some of the newer technologies. Is it's great if you have the data organized in a way that data is not available, but the outputs are. And so homomorphic encryption starts getting there. And I've also seen homomorphic encryption in different uses where one party has A, the other party has B, and you want to add them, and they each can encrypt the data, and then they can marry it together because the order of encryption doesn't make a difference. They can do double encryption on the data and marry data sets. And so it's actually a very good tool for marrying data sets in a nice way. The last piece is differential privacy, which I know a lot of people talk about. The thing about differential privacy is it's both a test and a technique. And so you can apply differential privacy to the synthetic data to see, is your synthetic data private enough and confidential enough? And can you reverse back to it? Or you can apply a differential privacy to data you've modified or are using to get rid of outliers that indicate, as we say, the granny riding the Harley in Fargo, North Dakota, who's a singularity. And so is an outlier in the data set. It will look for that And they'll also introduce statistical noise so that the output is sufficiently aggregated or anonymized so you can't reverse it. The thing about differential privacy to consider is it has a dial, in the sense of however much you want it private, you can increase the dial. The problem is the more you increase the dial, the more you can degenerate the utility of the data. So every company has to take a look at what their risk profile is and what the value they want out of the data, but it really is a useful tool to get there. The one thing I would also point out is these are not mutually exclusive tools. As you're looking at what your goal is and what your risk is, you should take a look and say, maybe I should start with obfuscating the data, and then I apply differential privacy. Or maybe I start from a synthetic data set, and then I do homomorphic encryption. These are additive, and it's really nice that they are additive because you now have a tool set available to you. And I would say all of this is moving quickly apace. There are a lot of new vendors and a lot of new technologies coming on board on a daily basis. So Rory, I know, had referenced multi-party computational tools. That's something on the horizon. I would say from our perspective, we've looked at it and it's not there yet, but it's something we're hoping for because what it would allow is combining data sets across parties and working for data across parties. So like a telco and a bank working together without them having to expose data to each other. And so therefore preserving the privacy of their data, but getting the insights that you need and you want out of the data assets.
It's like a delicate balance and a dance all wrapped in mathematics. Thank you, Andrew. I'm going to ask the question from our audience here to Rory. Are data brokers at risk of disappearing? Aha.
Oh, are they at risk of disappearing? Those poor, vulnerable data brokers out there. We're talking here about organizations like Datalogic, Axiom, CoreLogic, Rapleaf, a number of organizations which are collecting the data, scooping it off social media, shopping, use of your credit card, religious organizations you may be a member of, political affiliations, goodness, local municipal data. So we are able to aggregate this data and then produce lists and sell those lists onwards to organizations that want to sell products and services to us, which is not a bad thing. Remember, this is not a bad thing that people want to sell to us, but some of the concerns that are coming up with these data brokers is the sort of data, the looseness with which it's sold, and something distasteful in the manner of it. For instance, I think I read recently that some of the data brokers are selling lists of rape victims at something like 7 or 8 cents a name. So there's something just not quite right in here, and I think we're getting a rebound against that. You know, in the US, you've got the Fair Trade Commission looking at reining these in, requiring greater transparency, giving people access to data they hold, giving even the opportunity to correct it when it's wrong, when it's mistaken. You have these sorts of rights under the GDPR and other laws which are coming in. So I think we're going to see a shift in the market as they come under pressure. I think some of that's coming from the regulatory area. I think more than that, I think we're going to see a shift, maybe we are already, of just companies which use the data the data brokers provide, looking for greater responsibility in its sourcing. So sort of due diligence down the value chain. And so I think we're going to see more data brokers needing to show that to their customers that they are more responsible. They're not just scooping up any old data from any old source. So I don't think they're going extinct anytime soon. I'm hoping that some of the standards will rise. It's going to be a push to keep on getting there. You know, I think we're still at the very beginning. We're still very much in the Wild West here. So there's a long way to go before. It's not even necessarily a good idea that they're extinct at all. I think it's much more important that we get responsible, organized, privacy respecting means of data brokerage that makes data available under good governance mechanisms for good purposes, and that's going to involve some wise intervention, some setting of standards, perhaps, in that sector. Okay, back to you, LG.
All right, thank you very much. Margaret, I'm going to come to you next to ask, can you tell us some unconventional ways that you can communicate with consumers about data privacy?
Yeah, sure. So I'm really going to kind of extrapolate from what we've done around issues broadly of financial capability, because this is really, I think, as we're all indicating, a lot of this is quite cutting edge as we think about reaching, especially lower income consumers who may be new to digital financial services. But we think that it's really important to kind of go where the customer is, and I think that that's part of the problem when you think about this informed consent is, a lot of times these are written, by lawyers, and they're not necessarily written to make it easy for the consumer to understand. So, for example, we've worked with soap operas in several different countries around financial capability issues, in order to incorporate messages that we think are important for populations around things like high cost retail credit, gambling, saving and budgeting. And we found that it's quite effective and that people, and it's men and women, really enjoy receiving the information in that kind of more narrative format than the soap opera format. And those can also be radio. And I think, as a parent of three kind of young adults, for the next generation, really being aware of social media and the use of, short videos that can get messages across, that can really probably be more informative than, thinking that because we've got something that has a lot of detail, when somebody checks the box that they understood it. I think a lot more could be shared using, new technologies of those sorts, especially incorporating narratives, stories, videos, music. You've got the keyboard behind you, and also gamification, so that people go through maybe short games to see if they understood actually what what the context is. So you could, think of a lot of different ways that I think could be more actually effective in terms of people understanding what the aspects of the privacy issues are, and also what they're signing up to.
Okay, thank you. Alex, do you have some areas where you think development actors should focus to build capacity among consumers to engage with this sort of thing?
Yeah, I think building a lot off of what Margaret mentioned, we've been thinking about that as well. And just one thing to say, I think at a high level, when we've been, as a result of the research that we did when we started to think about what development actors should do, who should be at the table, one of our takeaways is that I think this topic can be a little intimidating in terms of, machine learning, advanced data science, and to those who are not kind of technical experts, it feels a bit opaque. But I think we need a diverse group of voices at the table who understand the consumers, who understand the markets, and a lot of the data scientists that we spoke to for this work, I think would be the first to advocate for that as well, in terms of feeling like they're the amount of decision-making power or being the arbiters of these very consequential decisions, is a lot, and that there should be a more diverse group, and that even if you're not trained as a data scientist or very well-versed in the particular technical aspects, there's still a lot of value to having different voices at the table, whether it's consumer advocacy organizations or researchers. So there's really, I think, a need for more folks to get involved. One of the things that we've been doing is thinking about, I think, very much aligned with what Margaret's research was doing, was trying to understand how the data rights that are part of a lot of these new frameworks, GDPR, or as Jonathan talked about, LGPD, how can they be operationalized so that consumers are empowered, whether it's informed consent or the right to an explanation by an automated decision, the right to having your data rectified if there's an error in terms of who's processing it, the right to data portability. I think if there's not awareness that consumers have of these rights or what's happening to them, what they're consenting to, there's really a gap in terms of understanding the potential data harms that could be taking place and consumers' ability to report or engage. And so USAID, it was interesting, they put out a request for information to gather actually evidence of harm that was taking place for women as a result of AI and development. And I think there was really a universal response to that, there wasn't a lot out there. And I think a lot of that might be tied back to a lack of awareness on the consumer's part in terms of what's happening in the data ecosystem. So I think the types of digital capability, financial capability interventions that Margaret mentioned are so important. I know there's some interesting behavioral research that's taking place in terms of different ways to test out the right to an explanation in terms of what a consumer is communicated after an automated decision has been made, such that they could understand it. There's just a lot more, I think, research and evidence generation that needs to be done, and I think that needs to involve a whole group of different types of stakeholders, like I said at the outset.
Yes, and slowly empowering the consumer. Those of you interested, there is a website called tosdr.org, which stands for Terms of Service Didn't Read. It's not necessarily financial, but it will give people exactly what rights they are possibly giving away when they simply tick the box at the end of a very long terms and conditions. And I'll put the link up in the chat for anyone who's interested in that. Jonathan, I understand that you wanted to talk briefly about the data brokers question. So I'd like to just bring you in on here before I head to Narayan for possibly the final question. Oh, you're still on mute. Please, can you unmute your microphone?
There we go. No, I think this links some of Rory's comments, but links to some of the things that Margaret and Alex have just spoken about. Because in my view, I think blaming data brokers or looking at data brokers as the villains of the piece here is a bit like saying, well, drug consumption is attributable to drug dealers. I mean, drug dealers and data brokers are filling an enormous market appetite. And so I think where we need to focus really is on the permissible end use cases of data and customer awareness, because I think that's what's going to change the behavior of data brokers and the sale of data in the market, rather than trying to cut off the supply. And really, I think that's my short point.
Okay, thank you very much. Narayan, I wanted to bring you in as well, because India is probably, it is incredibly diverse in terms of its population. And are there data sources that fintechs are using? What data source? I'll start again, shall I? It's a bit hot here in London on the one day of summer that we're currently enjoying. What data sources are fintechs relying on for propelling financial inclusion?
Sure, LJ. Yes, as you rightly mentioned, India is very diverse with respect to the digital penetration, and we've created digital footprint. So broadly, the three sources which are right now predominantly used by a lot of fintechs and NBFCs. One is the telco data. Second is government sources, because the government has given you some subsidy or the other, right? Either for your gas or for your LPG or something else. So that's a reliable source because it tells you what's your income status, what's your subsidy amount that you're getting every month. So that is one. Second is, which is picking up pace right now, is the utility data. So you've got your utility payments. So that is becoming the next reliable source, because 100% of India is now electrified. So there is enough utility data that is being generated. But yes, on and off, for a niche audience, you do have the payments data. That is your payment transaction, your digital wallet. But that's restricted to top 50%, top 50 or top 100 million population itself. So bulk of the population is government subsidies, telco, and utility.
Oh, I thought you were going to go on and explain them. Don't worry, that's absolutely fine, because we only have a few minutes left of our panel, which I'm a little bit sad about, because it always feels like we're just opening this present and there's loads of things to explore in it. But instead, I'm going to have to very gratefully ask for a few closing comments from our panel. So just a minute or two would be lovely for anyone who would like to just add a few things at the end of this. So Andrew, I'm going to ask you if you have any thoughts that you'd like to just close with as we come to the end of our time together.
Sure. I think, LJ, as you said, there's a lot here to explore and a lot of different areas, whether it's trying to understand and unpack consent, which is good luck on that one. No matter how much UX research we do, we never seem to get it right. The different regulatory conflicts of GDPR versus PSD2 in Europe, and lack of alignment, right, to technology. And I think as we all move forward, I think the most important thing is to continue dialogues like this to educate people, and so that people are able to understand not just their own silo, but how those silos interact with other people's silos and expertise, so that we don't work in silos. Because I think it's this cross collaboration, right? I had started out by saying open banking is consent driven, but then Margaret points out, wait, hold on. That's not so simple as saying that, right? And so she's right. And so therefore we all have to engage in this conversation, and we all have to listen and learn from each other. And so I think this was a great opportunity to do so in the beginning.
Oh, brilliant. Oh, my goodness. It's actually 25 past the hour, which means I'm going to have to wrap. And I must say thank you so much to all of you, Alex, Jonathan, Margaret, Andrew, and Rory. We're going to have to leave it there. Thank you so much for taking part. And a massive thank you to you, our audience, as well, for your kind attention and interaction. Speaking of which, audience, we'd actually like your help. We're going to display a very short satisfaction poll, which we'd be very grateful for you to take part in. And the session is recorded if you'd like to watch any of the sessions again, and they're up there with, well, there's quite a lot up there now. That will be available on the FIGI website. As you can see there, 10 very interesting and insightful. Amusingly, hosts and panelists can't vote, so we are relying on you to tell us how satisfied you are. Thank you so much. We've got more sessions available on Tuesdays and Thursdays throughout June, and we've got 2 coming up on the 8th of June. These are regulating intermediaries, part of the payments acceptance series, and guidance for regulating eKYC, and that's part of the digital ID series. Thank you once again, panelists. It's been incredibly insightful, and I'm sure that you'd be happy to be contacted by our audience via the usual social channels to talk about this all further. Thank you, audience. Thank you to the technical team and ITU and everybody else involved in organising today, and we look forward to seeing you again very soon. Goodbye.
Thank you.
Thank you.
Thank you so much.